back, everyone. Hope everyone's having a good week. It's been a tough start. Little counter trend action here in the major trends, the markets. Um, and we're here to talk about those trends. Um, Led by a guy who seeks out and tries to find apostates, people who kind of trend follow, don't follow the rules like they should. Little cultish behavior here. But the bond market, wow. I mentioned this the other day on the Schwab Network Futures with Ben show that I wouldn't be surprised if we get some whipsaws here in the bonds. The bond rally from the lows got some of the markets, the trends definitely, probably trend traders got long. Some maybe were able to stay short some of those bonds. It's kind of a mixed bag. But I wouldn't be surprised if we see some whipsaw action here in the bonds. You just can never trust these trends when they change like this. It happened to the dollar last year. Long, short, short, long, short. Now, what's going on with the dollar? Mixed bag there as well. Wouldn't be surprised to see the dollar rebound along with the interest rates rebounding. Nothing in the commodities. Nothing really going on in the commodities too much. Stocks, everyone is following those trends. I have a lot of longs and a few shorts. The longs are getting crunched, and the shorts, they're not doing too much either. They're not helping that much. So, kind of a sketchy start to the year. After a bad, kind of a struggle to end the year on a positive note. That was so 3 straight years of great performance in the trend following sector, and now 1 year and 1 week, not so good. A lot to talk about. Please go and read the tweets from this past week, the ones I put my heart and soul into, critiquing episode 2, part 2 of the reunion show, TTU reunion, without Richard. Really enjoyed that one as well. A lot of tweets on that, a lot to talk about there. Nick, I really like this Nick guy. He's a smart guy. He knows what's going on. He's the most entertaining of the group. If Richard's not going to be there, Nick's our backup. Entertaining guy, really smart. Goldman Sachs, kind of trend follower, but his he offers a lot of quality stuff as it relates to the other, a lot of the non-classic commentary is ho hum and not very interesting. Nothing I can really make too much fun of. But Nick is the superstar on that show. He's really, really good. Okay, Oleg, you ready to take over?
Yes. Hi, Jerry. Hi to everyone. Hi, Debonair. Hi, Seth. Hi, Ricardo. Hi, Cardo. Hi, Josh. Hi, Marcel. And everyone, there's a lot of people here, and I'm very happy, of course, to see all of you here every week. And as I always say, every day I think about our trend following trading conversations, and it was something I was dreaming about maybe for more than 10 years, really. When I started to be a trend follower, I was dreaming to find people who are also interested in this topic. I was dreaming to find experts in this topic, and it was hard. But I'm a very happy person. I find Jerry, I have found Top Traders on the podcasts, Needs Moritz, and all of you, and I'm very happy, really. So, happy New Year to everyone. Great start of the year. Great start because it's always great if you're a trend follower trader, because it affects many different fields of life, and it makes me happy. Not only in trading, it makes me happy because I have this wonderful mindset. And I have said before that if you have a mindset of trend follower, you are you will be a successful person in general. I think in all fields, almost all fields. So this week I was listening podcast, better trader podcast, as I remember. Uh, so with Jerry, part three, and of course I like this, and it's, I like it. Jerry was speaking uh, about very interesting and very important topic about over optimization, and we often speak about this topic. It's really very important to understand. For example, I like this words of Jerry. He said, "So we don't pay very much attention to the equity curve in the equity starts, the drawdowns and the volatility, and trying to smooth that out that equity curve. Whenever you try to smooth things out and increase your Sharpe, that's where it all begins. That's where the over optimization begins. And really, it's very important because people are to pay too much attention to over optimization, to looking smooth, to please their investors, and if it's when it's too much attention, the more parameters you have, the more fragile you are, and it's really so. And also, Jerry said that all we paid attention was the trade stats, an average win, the average loss, the average trade, the win percentage. We just want to find systems with healthy trade stats and that make the most amount of money. And also, Jerry often says, and I love these words, I often said over the years, I try to take as little from the backtest as possible. Here is a good place to buy. There is a pretty good place to sell. We are done. And really very important words here, because as I have said ago, this over optimization attracts people's mind too much. And it's a problem. It's really a problem of many systems. And when we will face especially very crisis environments, so something like that, some of these filters, not even only in crisis environments, in some different regimes. It may be only changing the regimes. Regime is changed, so your filters stop working, and you will have problems with that because the future is not the past, and it will not be looking as the past. As Jerry says, the future isn't the best guide. The past isn't the best guide for the future. It's very wise words. Also, maybe in all fields of human being. So let's get started. Very happy to be here, and happy starting of new year to everyone.
Thanks, Oleg. Also wanted to mention that, I've carved out a fifth sector in my portfolio, which is crypto. So I trade the crypto futures and about 25 stocks, companies that are in the business blockchain crypto, according to my in-depth research. So that's kind of been a rock and roll movement in the in that sector over the past few weeks, month, and this week it's been up and down a lot, and some big moves. And I guess we're going to get some resolution on the cash Bitcoin ETF, and that is driving some optimism towards the prices in those, well, at least in the Ethereum, and Bitcoin. So I don't know if you want to chime in on that, Seth. What are you seeing? What are you hoping for? Um, but feel free if you want to comment on the trends in the um, crypto blockchain sector.
Hey, good morning,
I think
Larry and everybody.
uh,
Thanks. Um, it's funny. I got a text from a mutual friend of ours last night, and he said, "What's up with these crazy swings in Bitcoin and Ethereum?" And I told him, I guess it's just crypto doing crypto things. Um, yeah, the ETF approval possibly coming today. I kind of wonder if it's going to be similar to the reaction we've seen with interest rates, where all last year it seemed like market pundits were saying that the Fed was going to have to stop raising rates and was going to cut rates. And then in this last Fed meeting, we actually got a little bit of acknowledgement from the Fed that they're likely done hiking and cuts are to come. And now we've seen like a counter trend in rates, where rates have started to creep back up again. Maybe the same thing happens for a Bitcoin ETF approval. Um, I don't know. I don't follow the news with crypto any more than I do with the rest of the markets. I just follow the trends, just like I'm sure most of us here do. Um, I was curious, how much have you noticed that your crypto related stocks track crypto prices? Is the correlation pretty? Is it pretty 1 to 1?
Well, initially when I trade, it's creeping up to 400 markets. So let's say I have high 20s or almost 30 of these, stocks and future and crypto futures in my portfolio. So it's a small allocation, right? Um, but when I first started doing this last year, adding all these stocks, because I had been trading the crypto futures for a while, and I was kind of like bemoaning the idea that they're kind of all look like they're really correlated, and so that's kind of a bummer. You kind of I think I'm out of 25 stocks, I'm probably long 24. They don't all look, they're not all making new highs when Bitcoin makes new highs, but they're usually up on the day. But that was dramatically broken a few days ago. I think it was earlier this week where there was a huge down day in those stocks across the board, and Bitcoin, let's say, was kind of unchanged or small negative on the day. It wasn't really much going on. And I don't know what happened on that particular day. And then I think yesterday, or the last, yesterday was up a few thousand or 1,500. And then I think there was a muted response in the stocks as well. So unfortunately, I'm getting what I traditionally would want, which is, hey, don't be so correlated to each other, so we can have some diversification here. But it's not working in my favor. I didn't want that kind of diversification. I wanted everything to kind of go up. And if Bitcoin took a breather, well, then the stock could keep going. That's great. But, it's not, you kind of like in a lot of situations like this, like in the currencies, and certainly, oh my gosh, there's no better poster child than the interest rates. The amount of diversification you really get on those things on a daily basis is kind of minimal, obviously. So if you're going to trade a lot of these things, like I do, or every interest rate under the sun I trade, and interest rate ETFs, um, it's good for me. It's like 30 some markets divided by 400 total. So it's kind of it's kind of like a bummer, but it's not a huge part of the portfolio. And trades, when the trade is finally over, 5 ATRs, 10. So the differences in the profit in the trades is pretty material, but on a daily basis, they kind of all went up or all went down to some degree, but not to the same degree. And overall, it was worth having them all because, I feel like I can't predict which ones are going to do best. And one group, the short-term interest rates, they start out the weakest, and then long-term kind of later on gets weaker. And so rather than trying to predict these things or use relative strength or something like that, I just stick with them all and play them out like a good boy, following the systems. But yeah, it would be nice to, and I don't have this ability, and I'd have to. This would be like a thing to run through your clients and compliance, and oh my gracious, it would be such. Can't even imagine how to handle this. To trade something like Solana, which I have no idea what that even means. Um, that's not on a like a stock exchange or a futures exchange. That I think that would be the next one. And when most people, and then Alp has given me crap for this too, which I kind of said too much a few weeks ago, and Alp was like, Jerry, that's just a bunch of stocks. You can't, in other words, you can't really count those as crypto. But okay, well, I'm doing it, Alp. So, but yeah, trying to pick up some of these other what real crypto people would consider to be coins and crypto and add Solana on there. I don't even know how to set up that account, and you'd have to probably get tremendous compliance involved and approval from clients to add something that's not a future and not traded on the stock exchange. What do you think?
Well, I use Interactive Brokers, and Interactive Brokers has a partnership with a crypto exchange, and you can invest directly in, I guess, what you would call cash cryptos through Interactive Brokers, and it's only like 10 or so cryptos. It's not. I don't think Solana is one of the options. Um, but I trade a managed account for a friend, and there's this weird situation with the micro ether futures where if you're I'm sure you're probably familiar with this, like there's certain like exchange limits for futures contracts where if you have over a certain number of contracts, you have to report to the CFTC or whoever it is. And with how small Ether got after the Ether futures came out, the micro futures, I was, even with my very small account size, was holding what was a reportable position. So I had to go through the whole thing like I'm a huge hedge fund filling out all these forms for the CFTC. And I was trying to avoid that for my client that I'm trading his account for. So I went to try to put on a trade with cash ether for him in lieu of the futures. And come to find out, Interactive Brokers limits you to 10% of your account size. And the position sizing for him would have been just over that. So I was like, well, here's a major roadblock. But like you say, it's still very difficult to trade crypto on behalf of clients. I guess the best way to do it is probably to open an account with Coinbase or Gemini or one of these big established crypto brokers. But even then, there's still a lot of weirdness going on in the last couple of years with client funds maybe being, commingled with exchange funds and whatever. But I guess it's still a new emerging area, and there's a lot of rough going to get it started, but it's probably like trading futures back in the 80s, maybe the first people to get in there and do it. There might be some inefficiencies that trend following can take advantage of in that sector.
Yeah, I'm not. I'm not 100%. Someone needs to kind of like not be 100%, and I'll volunteer for that position. I'm not 100% sure I agree, or I'm not 100% sure that trend following needs inefficient markets like that. That whole concept, and I'm not sure that's a valid concept. Not sure. Yeah, I'm just going to throw that out there. But I thought Solano was number 3. I thought it was tracking down Ethereum as number 3 solid coin as far as volume and interest and safety. I thought Solana was right there. We have this friend, maybe the same guy that you talked about earlier, Seth. he mentioned to me, this other friend, or same friend of ours, mentioned to me that the short Bitcoin future, long Bitcoin cash trade was looking, that was sort of dramatically back the spread there. So I'm not sure if that I'm not sure I'm strong enough to do that trade or understand how to do that trade. But certainly, as you mentioned, having it trade at that same place, long the future, short the future is long the cash. Yeah, doing it there makes me feel a lot better. Um, and I think that with anything like this, I had a friend yesterday. I was talking to him, and he's like, we're talking about crypto and stuff. And what I pretty much just said to you guys, I said to him, and he was like, "Yeah, it's like one part math and one part computers, or something like that." And I was like, "Yeah, but most people, a lot of people you listen to, it's 90% religion." And I think that this is a good area where trend following, offering a, 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 a strategy that trend follows these, unemotionally, just follows the trends of these different current crypto coins or whatever, and then maybe some stocks thrown in as well, long and short, just trend following that. It's a big service that someone could offer and get away from. I own this because, I just it's my religion to own crypto, and I believe, fiat money, blah blah blah. And so I think this is a good idea to look at these markets as, hey, it may turn out to be something, but regardless, we need to be sober and use a systematic approach to possibly profit and not lose all of our money and not be so concentrated in that regard. So,
I remember, get remembered now that Neil said maybe a few years ago that there is nothing else but trend following for crypto. Even if people believe in fundamentals or something like that, there is no fundamentals for crypto. Even for people who believe in this, there is nothing to believe. And I have seen a lot of examples when people believe in crypto only because it has a trend on these markets. And one guy, maybe near maybe a year and a half in May 2022, asked me, "Is it a good idea to buy and hold crypto?" And I said that it's awful idea because it is against the true philosophy of investment. It's not my approach, and it's only a story behind. It's only trend behind the script. And so, by the way, I think we have, and I have said this before, with SP500, buy and hold SP500, we have only story, only idea that stocks will be raising again, over and over again. But in fact, crypto, especially good in showing us how strong trend following is. Because there is really, I agree with Niels here that there is even no idea of fundamentals in crypto or something or macro or something like that. And trend following is certainly the best. Of course, trend following, for me at least, it's the best strategy that can be. But when we look at crypto and understand, even people who don't believe in trend following, they can look at crypto and say that nothing but only trend following approach is a winner here. Only this. And I saw a lot of people who wanted when Bitcoin was near 60,000 United States dollars, people wanted to buy and hold this. And it's a very bad, it's awful idea to buy and hold something, especially such unknown instrument. But people like this because I remember Mark Brzezinski said that memory of people is very short. It's really very short. So people see that.
No, I think that's a good point, Oleg. Um, and I think just looking at filling up your portfolio with all these different markets, especially for me, commodities or and stocks that you have no clue what's going on behind the scenes and fundamentals, and thinking you can throw them into a portfolio and just start trend following. I think that would create a giggle from a lot of people who don't trend follow, and throw in the crypto in there as well, which I think to some degree no one really knows that much about what's driving these markets. I've said before, it's like the perfect uh, trend following market because you're never going to be too enticed to deviate from your systematic approach based upon some sort of fundamental idea. Although we can deviate from our approaches based upon other things like too much profit, too many losses, too big profits, are very destabilizing. A lot of volatility. I think I just wonder. I sit there and sit through plus $3,000 days, and Bitcoin the next day is minus 1,500 or 2,000. I just wonder what people are doing. Like how do you deal with that? And I think people ask me, how do you deal with sitting there? And then after a while, you're like, yeah, it doesn't really help to do too much and do as little as possible in these kind of crazy situations. But it's difficult to do to like, to sit there and watch a lot of volatility and not kind of be invested in that momentary, temporary profit that you got. I give back a lot of profits, no doubt. I listened to some podcasts. I listened to some podcasts this week, and listened to one in particular. One of my least favorite big CTAs. It's there on my Twitter if you want to watch it. But this is really just bringing up one of these ideas about how the gulf between sort of classic trend, one entry, one exit, and a stop loss, the old-fashioned classic retro. That's a new word I picked up this week as well. Retro. I put it on my Twitter. Retro classic. I'm now retro classic trend following plus nothing, and the kind of modern, more modern managed futures CTAs. And so I'll just read a quote that I tweeted from that interview of this large CTA. It was a JP Morgan podcast. He says, as a trend becomes overextended, we will actually fade the trend and begin to scale back our position in the event that the trend has statistically gone too far. Wow, that's interesting, right? So, dude, we're doing this because mathematics and statistically, it's telling us you should do this. Now, I went to their webpage, and their tagline on their webpage is "The Science of Investment." So this is part of the science, and statistically gone too far. And this is like just a little snippet of how the gulf between the two different strategies. So once again, I think we've sort of said here and many times, like you can't predict how far things going to go. It can go further than anybody believes it can go. We've seen things go further than they've ever gone before in a particular market or just in general. You have these Eli Lilly 500, 600 ATR moves. And one of the problems with statistically going too far is that the sample size would be so small. Let's look and see how far these markets have gone. And that's the problem. The outliers don't represent very many of our trades. So I'm not sure where they get this magical statistics from. Although I'm not an expert in statistics, I am decent at repeating what other people who do know a lot about statistics say. That's really my talent. I don't know what to say. I know how to repeat what smart people say. Smart people about statistics. So I guess they measure how far markets have gone historically, and when you start reaching that area of the very few times have markets gone further than this idea, then that's statistically telling them that it's gone too far. So I guess with the vol management and correlation management, though, you really don't get too many of those because as these markets, and they're pretty much all going to be longs, and usually on these big long trades, the vol, regardless of what you hear other people say, it's silly talk. That the vol usually increases dramatically, from entry eventually to when you start to get towards the deep into these trends. Let's say the vol has a tendency to increase pretty dramatically, and then they would just be peeling that off anyways. So I guess they have a third way. The correlations are getting heavy, so cut back. Vol is getting massively bigger, so you cut back. And then I guess you have this overextended statistic. It says markets usually don't go this far. And so it really is sort of a interesting way of looking at it. I don't know if anybody wants to comment on that.
I'm sure you've probably tested this in the past, and I've tested it as well. But if you say, okay, if I look at all my trades and 90% of them don't go past, say, 10 or 15 ATRs, if I set a profit target there and take profits, what does that do to your back test? To me, all that's done is reduce the compounded annual growth rate without drastically improving any other statistics I care about, like max drawdown or things like that. What's been your experience when you test those kind of rules?
Honestly, I don't know that I've ever tested them. I came out of the wombs a big, huge believer, and I never probably even looked at it. But I think I think you can be a little more sneaky than that as well. And that would be you have the computer tell you that precise point, and it will tell you precisely, if it goes 23.13 ATRs, that's the break even. That's it right there. And it will actually maximize your profit. There is a number out there that if you plug it into the computer, based upon history, it will maximize your profit. And so that is enticing. Now, the problem is, if you live a couple more years beyond that, the date range of that back, oh, darn, something just went 208 Tesla, Eli Lilly, all the big trades, sugar, cocoa, whatever. You start getting too many of those and they get beyond that optimized number, then you kind of have to redo the number again. Now it's no longer 23.13, it's some other number. And one of the things that is great about trend following is if you just have that loose pants trading stop, you're kind of just going to pick up on all of that. And you don't fall prey. I know Richard doesn't really agree with this, but you don't really fall prey to analyzing numbers with a very small sample size. So this is the conundrum. You make money because 5 or 10% of the trades are outliers, but you can't analyze 5 or 10% of the trades. There's just not enough of them. So if all the trades, regardless of the size, are produced by the same entry, exit, stop loss parameter, you can include all of the trades. Oh, but just so happens that 40% of those trades are winners, 60% are losers. Oh, and then 5 or 10% really make all the money. But you can include all of those trades in that sample size, even the big ones, because you're doing it based upon the idea that they were all created using the same parameters. Now, I don't think Richard agrees with that. He would say it doesn't matter. You can't gain any knowledge about those outliers because they're too few in number. And I guess If you strip them out of the big back test, I agree totally. So you can't really look at those numbers, those 5 or 10% of your trades, and say, uh, this is a meaningful characterization of what I should accept, what I should expect in the future. That once you hit a certain level, it's just really, really unlikely the trade is going to keep going. I don't know how the science of investing and PhDs get away with this sort of stuff. I mean, I really just don't understand how they do it. And someone doesn't call them out because I can't really call them out, But to me, it just doesn't make a lot of sense.
Hi guys. Can you hear me?
Yes.
Hey Jerry.
Yes.
Hey Josh. Hey everyone. Hey Oleg. Hi guys. Hi Seth. It has been quite an interesting couple of weeks, to be honest. So you know I'm a classic trend trader, but I trade shorter term. So there are times where the short term and the long term performances decouple, and December was one of those months, and I would say the credit has been a big win for me on the shorter term, because you pick these bonds from the bottom of the market, and and you just trade them to a level, and then it hit my exits and I was out. So and I was looking into the industry. Majority of the people have struggled on November and December, and it wasn't the case for me. And I said, wow. So this decoupling, of course, doesn't work in my favor all the time. It's important to emphasize that. So these relationships change. It is important to emphasize that. Okay, so it's not about bragging, but it is important to note that the November December actually wasn't that bad for all trend traders. So it's just a point out there. In terms of one of the points that I like to talk about, this equity risk weight. A lot of people have made a lot of money 2022 by trading credit, and there's a big equity market run since the beginning of the November, and if you are a medium to long term trader, you're going to pick up those trades a little late in the cycle, but still it makes a difference if you're allocating 25% or 50% or somewhere else in between. And I'm a big proponent that equity trading can handle more than 25% risk budget allocation. So and when I was looking into some of those names that are producing negative returns for the last 2 months, and possibly some negative returns are going to be bigger than the others, and especially the ones that are bigger are probably not, they probably have allocated equity 25%, and the ones that have allocated more than 25% are going to have a smoother November, December. So this is actually one of the things that we don't talk about, this market type, because in long term, Jerry Parker says the number of trades are too low, and so there's really the impact of the market type is not there. In terms of the parameter set and the system, maybe so, but in terms of whether you're making money or not, you make money when you have the market type. So there's an equity bull market going on, and everyone else is riding that with different risk budgets, as I mentioned, some 25%, some 50, and some in between, and you're making money specifically from equity trading because you got the market type. It's very important. And you don't have that market type in credit, you don't have that market type in forex, you don't have that market type in commodities. And then what happens if you don't have the market type? Well, you have to catch those outliers. So that's the way to go, basically. But market type means sector moves. So you got the sector move in equity trading, and everyone else is going to benefit from it, irrespective of whether you're short or medium or long term. You're gonna catch up those trends at some point, and that's very positive. That's very good, actually. The other interesting point is, like, you know, I've seen Olex's tweet. I think Debonio was talking about it, that you have, if you're risking small ATRs, then actually you risk more. And I said, yeah, it makes so much sense. It's so true. With small, if you're using tight pants as opposed to loose pants, if your stop loss is smaller, as opposed to something looser, whether you're doing it like myself, using minute bars, or whether you're trading daily bars, it's the same idea. In 2023, if I would have been using a smaller ATR, then it would have been a difficult 2023. If I would have been using a much more looser, much more larger ATR stop loss, then the results are coming much more better, of course. And we need those years, because when we talk about these small stops or large stops, we don't actually say why all the time in this conversation, but it is important to emphasize that not every year is like 2020, then 2021, and then 2022. Not every year is like that, because if every year is like that, and you've got these massive trends, then you can do, you can use your open equity as a base to position size, and you can surely use smaller stops, but not every year is like that. So when you end up with years like 2011, 2018, 2023, and other volatile years, or other choppy years, those are the years that you need those larger stops, and you don't know what that year is going to look like. So that's why you use larger stops as opposed to smaller stops. But it is very I'm finding it very important to continue to use that larger stops, and it makes a big difference, really, on my trading. Yeah, right. That's all for now. Thanks a lot, guys.
Yeah, I got confused by all of that. And I don't think I agree with Oleg's tweet. That's not been my experience and my way of doing things. And I think I understand what you guys mean, but um, I optimize on my back test the um, the multiple of ATRs. I think that's what you mean by small stop loss, large stop loss. So
Yeah.
one ATR, two ATRs, doesn't work on the back test as well as a stop loss that is greater than that. At some point, um, the the multiple of ATRs, it really stops changing its characteristics. So with a one ATR or two ATR stop loss, that's going to have a lower win percentage than 4 or 5 or 6 or 7 or 8 or 9 or 10. Okay, so it goes right to that percentage thing. Of course, because you're too close to the market and you're always getting whipsawed. Now, we're not even, which I've mentioned many times, which is, you have to get back in at the high, but the high is higher than it was when you originally bought. So you could have a really tight stop and get in, out, in, out, in, out, in, out 4 times. And by the 5th time, you've got to get back in, multiple ATRs above the original. And someone who has a ATR of a multiple greater than 2 or 3 or 4, they're like sitting there with this position on with 4 or 5 ATR profit, and the other trader with the shorter term ATR is just getting chopped up with multiple losses in a row, getting back in at a higher price and a lower ATR and a smaller position. Okay, so there's so many reasons that the computer comes back and says, hey, calm it down. Your ATR needs to be much bigger than 1 or 2. You're just crushing yourself here. Now, I've always traded the same, number of contracts, let's say, or the same position size, regardless of if I'm using one ATR, two ATRs, or something much bigger, because I'm getting the lower. It's okay. It's being offset. My lower win rate is being somewhat offset by my smaller loss. So at best, and in most of the situations, it's going to kind of be like a break even. You're not able to trade larger with a tighter stop because you're losing more often. It's not, and it has all these other negative factors that I've just come up with. So now, if you get to the sweet spot and you go beyond that with an even bigger stop loss, I'm still trading the same number of contracts, the same position, and that's because it's just you're getting some diversification if you use a 5 ATR stop and a 10 ATR stop. 10 may be too large for me. I don't know if it really helps to have a 10 ATR stop loss, but I got to look into this and refine my thinking. I just haven't looked at it in a long time, but I'm pretty sure I don't agree with ipso facto. If you use a 2 ATR stop loss, you can trade larger. No, I'm pretty sure that's never seen that, never done that, never was taught that. No, pretty sure I can't agree with that. But I don't want to say too much more. I got to look into it and think about it some more. I have these trusted advisors who've been doing back testing for me for like 30 years, and they'll weigh in on this and tell me. I forget sometimes some of these sort of what I would consider to be sort of eternal truths I figured out by doing a lot of back testing, which I like to rely upon, And one of them, for instance, would be this idea that the shorter term the ATR stop loss, the lower the win rate. So it kind of starts balancing out. Smaller losses, lower win rate. Higher win rate, bigger losses. So you can see it's like the market's not sort of going to give you anything. It's always just pros and cons, and they kind of, to some degree, equal out. A quarter ATR, half ATR stop loss, that's just nowhere but downhill. But the 3, 4, 5, 6, 7, 8, 9, 10, probably all kind of are the same thing over 30, 40 years worth of a back test.
So, Jerry, would your position size be based on your largest ATR stop that you use?
My position size is based on the ATR. So whatever the ATR is, that's my position size. So the amount of money it's kind of hard to explain. I almost said the wrong thing, but it's kind of hard to explain. I've got to think of a way to explain it. But let's just say that if I used a 2 ATR versus a 5 ATR or 4 ATR, to keep it simple, I would lose twice as much money on the 4 ATR, but the position would be the same, obviously. If it went 4 ATRs against me, I would lose twice as much as if my stop loss was 2 ATRs, but the position itself would be the same. So my max loss would be twice as large. So rather than 25 basis points, maybe 50 basis points, but they're kind of equal because I'm taking more losses on the 2 ATR approach. That's the way I kind of look at it.
Ted, you were talking about Interactive Brokers crypto suite and some cash products. I think their funding charge should be quite high, right? Like above 20%, if I'm not mistaken, to trade those crypto products. This is what I heard. Would you know?
What do you mean?
Ted was talking about Interactive Brokers crypto coins.
I don't trade those coins. Yeah, I don't trade those coins. I just trade the stocks.
But you wouldn't know the funding, would you?
No, I've never traded them. I trade the Bitcoin, Ethereum futures. I don't trade the, yeah, I don't trade the coins.
So
And just buying the coin though without leverage, there's no big fee to that. Would there? Would there be a fee to that?
no, there wouldn't be the fee to that, but there will be a funding charge, daily funding charge, to be able to hold the cash position. So it is important.
So
This
what other markets charge a daily funding fee to hold a cash position? I don't get it.
Yes, so that's what happens. So, for instance, I'm holding my equities. I do have cash equities, so I'm paying funding charge for those to the broker. So one of the advantages of using futures is you don't have that funding charge, and that funding charge is usually for the benefit of the broker. So it makes a difference over the long term. So that's why a lot of people would choose to trade Bitcoin because there's Bitcoin futures, or Ethereum because there's Ether futures, but there is no futures product for the Litecoin, or other or Solana, or whatnot. So is that's why when you actually plug in your algos into the Binance or other crypto exchanges, you will immediately start trading these, but not everything else have futures products. So for you have to pay interest charges, and those interest charges are, of course, those funding charges are cheaper with crypto exchanges, but you're introducing other risks into your portfolio when you actually plug in your algos into those crypto exchanges. But having said that, it's important. In 2023, in my portfolio, crypto was a very important part of the game. So without the impact of the crypto, there would have been a few missing outliers. So it was, and it still is, a very important diversifier. It's important to trade that, and I'm finding that the opportunities are a lot. So it is, and in this market, this Bitcoin ETF, I'm finding it is going to be a game changer. To be honest, one of the reasons is, as I mentioned, you know trading Bitcoin is very expensive. Okay, now so if you don't want to trade Bitcoin futures, if you want to trade Bitcoin cash product, you have to pay that funding charge. And I'm using a very top notch, very well known broker, and they don't have the features, Bitcoin features, so I have to trade the cash product, and I have to pay the funding, and that funding is really a hilarious amount. So what happens is, with this ETF, Bitcoin ETF, the entire land, not only the top brokers, but also the smaller, the medium-sized brokers will be able to actually trade the ETF. And of course, it's a big concern for brokers, people who are working on the brokerage end, because their cash cow is going to be limited with this new ETF. And people like myself who are trading those cryptos as part of a diversified portfolio, it's a game changer. So it's very important. So I'm looking forward to it whenever it's going to be available. But it's definitely more access, more liquidity, lower costs. Who doesn't like those concepts, really? Thanks.
That's another thing I don't understand. Maybe Seth can enlighten me on this, but I really don't understand why there is a need for this Bitcoin Cash ETF. You have these perfectly wonderful futures that, according to the SEC, or futures contract has been deemed more safe by the regulators than the cash. And then there's this arb that can go on if it gets out of line, sell the futures, buy the cash, or vice versa. And you put up this money for the margin. 95% of the money then goes into treasury bills. And it's this, if you own the SPY, you make the same amount of money as if you own the S&P future and put the balance in a treasury bill. It's the same thing. So why is there this need? Why all of a sudden, what's the problem with these futures-based Bitcoin ETFs? I would never, I'm not going to say I never would do it, but given an opportunity, an option, why would I ever choose? I didn't even know about this funding fee stuff. This is outrageous. And then, naive in this, but I guess, reading the headlines that you can get your Bitcoin Cash stolen. And I guess that's the issue with the SEC trying to fight this thing and fighting it successfully until there was a court case. And so they're still not on board with this. They just are forced into accepting this. So what am I missing here? Do you know, Seth?
To talk about the funding rate to begin with, as far as I know, the only time you pay a funding rate is if you're trading on margin. And with cash cryptos at Interactive Brokers, I don't think there's any kind of special fees, and it's really low commissions. As far as why a cash Bitcoin ETF is so important, I think it does have to do with the custody issue of Bitcoin. I think one of the big things about Bitcoin is that it's a unique asset. Each coin is, there's a limited number. There shouldn't be any like rehypothecation like with banking reserves where a dollar can be actually multiplied out and 10 people can think they own the same dollar. So I guess part of that, the cash ETF thing is that kind of like with GLD, if you own a share of GLD theoretically, or I guess in reality, you own a certain fraction of gold bullion. I think a cash ETF would do the same thing. Say if you own one share of a ETF, then you actually own one real piece of a Bitcoin.
Yeah,
There really doesn't get to the point though that your bank account is going to be no different if you own the cash GLD or Bitcoin or the Bitcoin Cash ETF compared to owning the future. We trade the futures. We like the leverage piece, but we don't trade stock futures. We go there because of the liquidity and the access. And in some respects, futures gives that to us in some of the commodities that I don't know where to get it anywhere else, right? I think that some of the big hedge funds do. They own oil tankers or whatever. But I really don't understand. Now, I can answer my own question probably, which partially it would be something along the lines of, well, the cash Bitcoin, I guess maybe you will get, I would assume I used to be an accountant, do tax returns. So maybe the cash Bitcoin, you'll get that long-term capital gain, where I guess in the Bitcoin futures, you only get 60-40. But I guess people do hold Bitcoin for years and years, and they want to, I don't know, are those the same people who refuse to ever sell though? I guess that's a good thing because they just keep holding it. It keeps going up in their mind. It's going to keep going up, and then they're going to never pay taxes. And when they finally do, it'll be at these low rates. And then with the Bitcoin futures, you get the 60-40, I think. But yeah, I don't know. It still doesn't answer that ultimate question. If the alternative is the futures, which are perfectly fine and great, as long as the premium, the contango of the future is armed.
yeah, but there are many cryptos to trade with, so that's the main difference.
No, but the issue that I brought up, and I agree, but that's not on point. The issue I brought up was Bitcoin Cash ETF. Why do we need one when we have Bitcoin futures? Bitcoin Cash Solana ETF, cash ETF. Oh, I'm all for that. But if the CME came out with a liquid Solana futures, I'd have the same question. Why? Why do we need? If they existed before the futures, which I guess usually is what happens in markets, right? I mean, the futures don't come first. This is kind of a unique situation.
I mean, of course, the ETF is for the retail investors to be able to make the access
Yeah, but
more
I agree.
easier.
I agree. But I know, but you're missing the point. There is an ETF. There is Bitcoin ETFs. They exist. They've been around for a long time, but they're futures based. Why do we need the same thing cash based?
Because look, a lot of people do not have access to those ETFs. I'm using a top-notch broker. I don't have access to, a Bitcoin futures. So I'm living in London. So in London there are many brokers that does this thing. So it's just when you have the ETF, it's just like democratization of the fees, the brokerage, the access. Because if you cannot trade the futures, then you're ending up paying a lot of funding fees while trading those CFDs. So in United States, you don't have the CFDs, so you're not talking about it. But in Europe, we have CFDs. CFDs is very common, almost anywhere else in the planet apart from US. So as part of the CFD trading, which is not common in US, but almost everywhere else, like Canada, like Europe, like Australia, you end up paying those funding charges because you trade the Bitcoin and the Ethereum usually with CFDs and with the margin, so you pay outrageous amounts to your broker. So so how are you going to make the excess? So how are you going to take the fees and the costs of this product much more lower? And of course, as the costs come down, there are people who are just trading cryptos, right? Since in the last 10 years. So and they are talking about returns like 1,000%. They're approaching to the space more like crypto space, more like a gold rush. An opportunity is going to disappear at some time, and every year that opportunity gets lower and lower compared to the previous year. So and then what are you going to do? Some people decided to go blank on it, just missed and said that I'm an established investor, I'm not going to get into it. And some did. Some said that, okay, I'm going to take I'm going to do something else with Binance. Some people plug their algorithms there, which is a high risk. Who would do that? We know what happened with the FTX, don't we? So it's high risk. But it is one of the risky ventures of our lifetime. The emergence of crypto and the gold rush and these 1,000 percentages and whatnot, and what is becoming of the space now. Thanks.
But I mean, yeah, I mean, everything is kind of dangerous. I look at it all as, I don't care what you call it, it's all dangerous. It's one of 400 markets, and I'm taking a small loss. I got my stop loss in. And so the super dangerous becomes way less dangerous. And however, it's not completely without issues. Can you have a problem trading 400 different markets and taking small losses on every one of them? You sure can. Oh my God, you sure can. You've done all of this, but you're just probably going to be better off than most people. Okay, I'll give this a little bit more. Who wants to weigh in on?
I wanted to ask.
Bitcoin
I wanted to ask.
futures and Bitcoin ETF.
Can you hear me? Hello. So so there's an ETF. I think it's called.
Okay, no one. All right, good. I didn't get my question answered.
Sorry, Jerry. I think you're not here, and there's someone speaking.
Oh, sorry.
It's like in a different network. Now go ahead, Jerry. It's a question to Alp. Alp, I don't understand. You're saying that you're getting charges, even if you're using 100% of your capital, they're still charging you for trading these kind of securities?
I mean, it's you know, the legal contract is different, right? As I mentioned, in the developed countries in the world, apart from US, you know, US is way behind the curve. There's something else called CFDs. Now, because of historical reasons and whatnot, US does not have those CFDs, but everyone else does. So in Canada, you have the CFD trading. In Europe, in Germany, in England, you have the CFD trading. In Australia, Richard trades CFDs. I trade CFDs. Almost anyone else in Europe trades CFDs. So with CFDs, yes. So it's like future. So CFDs has two versions: cash CFDs and futures CFDs. And yeah, you don't pay funding for the futures CFDs. You pay funding for cash CFDs. And in Europe, it is pretty much the cash cow for the brokers to be able to provide those in Ethereum and Bitcoin, more for the cash CFD side. So they are charging high interest rates. And these guys, how are they going to make money otherwise? There's quantitative brokers, okay, which is the benchmark broker, and and quantitative brokers has pros and cons. And if you don't like those cons, and if you want to go elsewhere, you end up trading with these CFDs. And interactive brokers does not provide the full CFDs as well. So you end up using possibly two brokers, but that's how you trade usually. I'm trading 6 digits, so as a 6-digit trader, CFT trading is like wow. It provides you everything else, but some people take advantage of it. So this ETF, this crypto ETF, Bitcoin ETF, is a huge opportunity to provide access and to cut the costs, of course.
Okay, but just to be clear, these things or the way you use them, they are giving you leverage. So it makes sense that you pay for that, and then you can do with the rest of your money mainly invested in something that will cover up part of those costs.
Yeah, but you don't pay the funding charge for futures, CFD futures, right? You only pay funding charge for CFD cash products or CFD spot products. So that's point number one. And the point number two, there's an interest charge and interest charge, if you know what I mean. They are at the moment in Europe, if you look into the interest rate charges, they are pretty high to be able to trade, these unknown crypto products, and these interest rates are even higher if you would like to trade like Litecoin, because there's not even the even the futures version of it. So the more you would like to trade the more unknown, less liquid ones, where you don't have the futures, and the almost, apart from Ethereum and Bitcoin, you don't have any futures. So you have to pay some sort of funding charge, and it is they charge you pretty high amount on that. So it is because many traders in this space are American based, so it's obvious that it's natural that you don't actually end up trading CFTs. So I would be keen to understand what Richard does to be able to trade Bitcoin, but he's not here today. Thanks.
Thank you.
I had a technology glitch and I had to log off and come back on. So that's what I recommend. I don't know. I can hear you guys, and of course I can hear myself. But okay, I want to move away from Bitcoin, and I wanted to at least get into one of the tweets I had concerning Top Traders Unplugged Part 2 of the reunion show. So I was listening to this and listened to it multiple times, and it was really interesting. And I'm really sad Richard's not here. He's on vacation, back at the end of the month, I think. So This is a very interesting quote, and the first time I heard Jim say this, I was like, "Oh, darn, this is a bummer." And yet, when I listened to it a few times, I think he's making the case that okay, I'll read it to you, then you can, and then I'll make a comment, and we can discuss this if you like. He says, "A market structure is constantly evolving. Sticking to models from 5, 10, 20 years ago, where market structure is different, is a flawed process. Time intervals matter. You don't want to lose the core things that are important to trend over longer time intervals. But over any period less than 1 to 2 years, you have to be mindful of market structure and you have to be evolving constantly." So I think he lets us off the hook. He lets me off the hook. I think I am okay. I think he sort of says if you're sticking to models 5, 10, 20 years ago, then if your system is short term, then you may be in trouble. You've got to be constantly, the flows and the structure of these markets is constantly changing, and you have to evolve constantly because you're looking at short term periods. But if you're looking at long term periods, then your trailing stop is a long ways away, like mine, then hundreds of days lower, 100, 200, whatever days lower, then so much change in the market is happening above your trailing stop. In some, if you're looking at a chart, all kinds of crap is happening, but it's not getting close to your trailing stop, even though you're going to get knocked out. But maybe when you finally get knocked out, it has less to do with structure and flows. And yeah, I don't even know what that means too much, but I guess he does. And I know he's big into flows and structure, but I felt like that he was giving me the business for trading, for not updating my models from 5 to 20 years ago in a meaningful way, not in a meaningful way. And yet, I think maybe at the end he says, okay, if you're going to be really long term, over longer time intervals, you don't have to be so mindful of the market structure changing. You don't have to constantly evolve. And I think that's sort of what our back tests kind of show, is that these longer term systems, they have done well for a long time. They continue to do well. There's no kind of, and then my favorite, Nick, goes on to say, once again, he repeats this from the previous week, which I love. I'm glad he did this. He says, we think about complements to 60/40. How about we replace it? Question mark. I'm a believer in diversification and prudent risk management. Is it about complementing 64 or really reshaping it? And it's kind of interesting that you have this panel of people all kind of involved in managed futures, trend following, CTA world, long, short, currencies, commodities, stocks, bonds, probably not crypto, but all the different markets, all the trend following, as much diversification as you could possibly get. Who has more diversification? Who has better prudent risk management? The two things he says that he's a big believer in. He leaves it out there. What about replacing 60/40, with something, right? No one has a clue. No one picks it up. It says, aha, how about with us? Currencies, commodities, stocks, bonds, long, short, trend, risk management. Why doesn't that become the new 60/40? It has stocks. It has bonds. We've seen kind of like it's probably not a good idea, understatement of the year, to always be long stocks and bonds. You can be long some stocks. You can be long some bonds if they're in an uptrend. But my God, I don't think I want to be long in a big, huge monster bear market, right? And yet no one steps up. And in fact, Neil says to the next person who's ready to speak, do you have any ideas about this? And he goes, none, not a clue. The whole panel. Zero. Maybe it's private equity, I guess. I don't know.
I mean, one thing they decided to call themselves in that. So I've listened to the first, the second one, both of them, and they are calling themselves model traders. So I think, and Niels started to, introduce himself and the work that he's doing, I guess, and all the participants there as we are model traders, and I wanted to hear your thoughts about that. That's a new hat, you know. I'm running a model. A lot of trend traders run a model, but identifying yourself as a model trader, opens up, I guess, a totally different world. As a model trader, I trade these. I design these quantitative, automated models, and I trade them. Is very different than I design these automated, quantitative trend following systems and trade it. There's a big
Oh,
difference.
that's very good. Good job. You can never. That's a huge positive characteristics for people, and that is to listen very closely and pick up on what seemingly might be considered an innocuous little statement, but you got it. That's very good that you picked up on that. I did not hear that. I mean, I hear so much junk that I can't, at some point you just can't pick up on everything. I can't, but very good that you picked up on that model. This is going to be a topic for next week, I think, because this is a very good topic. I need to think about this one some more, but this is a very good topic. You know, Back in the day, I remember having a, a specific opinion as to the difference, that there was a big difference between systems and models. And systems are kind of, every day you're going to have a trade, possibly. You've got this system, buy, sell, and then you have different systems, like I do, and you're buying, you're getting the gear with the trend, you're buying these different breakouts, and it's definitely possible for my system, my shortest term system, to be short in a market where the longest term system is still long, for instance, or vice versa. So the systems are acting independently. They're doing trades. They have things to do, and they can conflict with each other. And a model, I can't really remember, but I remember people saying to me, like, models are different. Models, I don't remember what I thought the definition of models was, but it makes me think of like more loosey goosey. Like the model says we should be, long or short. I can't really remember what models are. I just think that they're a little bit different or materially different. And since they don't really, the managed futures CTAs have moved away from one entry, one exit, and a stop loss, and they don't even to more portfolio overlay. It's more like what's in an uptrend, and then let's start adjusting based upon correlation, volatility, and relative strength, possibly. So so I think they're probably not very systematic or system builders any longer. They're more model driven. But I can't really come up with a good definition in the difference between a system and a model. Can you?
Yeah, of course. I mean, now look into the work that they are doing in TTU. So, I think the biggest change is they are getting apart from, trend following, but also, introducing other model traders into their shows and into their thinking and into their, into the work that they are doing. Like, you have given example from Cem Karsan. So Cem, a Turkish guy like I am. So he's not he's anything else but a trend following trader. Of course, he does what he does. So that's another model for you, and then another thinking for you. And the DBMF is another model for you, the replication. That's there as well. So and and of course, when you introduce these negative skew properties into the trend following, so that's another work to be able to done there. So that's interesting. So yeah, that's why I would be, you know, and this, when this conversation changes, and these people just give this similar message, the higher sharp, they continue to give higher sharp, they continue to give dynamic position sizing, and this with the model, we are model traders, is the latest, gravitation on that actually. So that's the new thinking, and I think that's what is happening there. And on the first one, they asked a question around, what is a classic trend trader? What is a classic trend trader? And the Niels was saying that, okay, well done to you. You're very inclusive, and if he doesn't found the definition very inclusive, Niels wasn't very happy about that definition. But and that's another thing. Everyone else is proud of the work that they are doing, and we don't have to, even though we are under the same umbrella, the trend following umbrella, some are uh, classic and the others are not. And so what is your definition of classic? So that part of the conversation was very interesting, and
Niels got confused. You know, they 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 can't stay away from talking about me, but they don't like to mention my name. But Rob was trying to make the point that, yeah, I don't know why they care about all of this stuff, but I care about making a distinction between classic and managed futures because it benefits me. It's a marketing idea that to make people aware that there is a difference, and that maybe some people, if they knew that managed futures CTAs don't let profits run and they care about volatility, having nailed down the possibility that the trade is not going to be a loss, so there's not going to be a loss of capital, then the trade, as it gets profitable, if you play around with that, the algorithms that you can devise that says, hey, you can hang on to this trade longer and accept more volatility because it's not going to turn into a loss, allows you to make more money. And it's just purely selfish for me to make that distinction. And, but, okay, I don't know why I got there, but like what Rob was trying to say was that basically he has more in common with the person who trades stocks, even though he doesn't trade stocks. He said, I have more in common with someone who trades equities that trends follows the equities than I do with someone who trades futures but isn't a trend follower. And Niels got confused and said, well, then that would make Jerry not a part of managed futures, or but Rob was saying the opposite. He was saying, Jerry is part of our situation because he trend follows, and it doesn't matter that he trades stocks versus indices. To me, it's more of like, how do you trade? So you are in managed futures or you are a trend following person, and we all have this in common. And he didn't correct Niels when Niels says, well, that makes Jerry not part of our group. And so I don't know, it was all a bit confusing. The agendas were going to be achieved regardless of what was being said. Rob didn't correct him on that, but it's fine. But to me, I don't understand. It behooves any of us, all of us, to have fun with this and to promote our own strategy, because I do think that there are people who can see through the issue here and say, "Oh my gracious, I would much prefer to let profits run fully, and with this situation when you have these big profits, not consider volatility and correlation in a risk calculation. Just hang on to it and maximize the profit. And how can you even consider yourself to be in the trend following camp when you have statistical measurements that say the market's gone too far, and we're going to get out, or we're going to vol manage, correlation manage, not play for the outlier? I think it's just a minor thing, but as far as well, it's not a minor thing. It's the root. It's the cornerstone of trend following. It's what trend following is all about. Getting rid of stop losses, which is this is becoming more prevalent as well. There is this issue with stop losses, which, trust me, there is no issue with stop losses. I made statements on stop losses many times. I'm not going to repeat them now, but I will in the future if you want me to. But stop losses, take small losses, let profits run. They've gotten rid of the stop losses, but I think they take small losses. Okay, all right, okay, I think that's fine. That's probably close to being the same thing. Don't let those losses get out of control. The systematic application of getting out after an XATR retracement, that's pretty hard to beat. The application of that strategy and then letting profits run. I mean, I do think it makes sense that if you're doing that and you have a few $100 million under management and you're going up against the CTA managed futures industry that has billions under management, then it's worthwhile to kind of maybe mention that hey, they're talking like they're trend followers, but hell, you don't even have to listen very closely to realize that they're kind of not. They're gutting the very essence of what it means to be a trend follower. And if that's going to benefit all of the rest of us in growing our businesses and distinguishing between managed futures CTAs and trend following CTAs, then so be it. They would use it as well. They do use things in their marketing material that helps them get money in the same way that we should as well. All right. I'm going to cut it a little short today, and thank everybody for being here. And we'll get back at it next Friday. Have a good weekend, everyone.
Thanks, Jerry.